Okay, it's just gone midday, so I think we'll make a start. Thank you very much, everyone, for joining us. My name is Helen DL. I'm the Director of Public Policy for the IUA. Welcome to this briefing about supply chain risk in the cyber insurance market. We're here to discuss a report that the IUA did jointly with CyberCube on supply chain risk in cyber. This is a webinar. We're going to have a discussion as a panel, and I am joined by Thomas Clayton, the head of cyber for Zurich Insurance, who's also the chair of our IUA Cyber Underwriting Committee, and Jon Laux, who's a VP of Analytics for CyberCube. There'll be opportunity to ask questions through the question and answer button that you can find on the Zoom. So please do put forward your questions, and we will come to the questions that our audience submit at the end of the discussion. But please, we do encourage all participants to put forward their questions if they have any. So without further ado, I'm going to start the presentation. And I guess the first thing is to outline is welcome to Thomas and to Jon. Thank you for joining us. Thomas, what was the motivation for the IUA Cyber Underwriting Committee and CyberCube to embark on this project in the first place?
Yeah, sure. Thanks, Ellen. Thanks, everyone, for joining. I think it might be good to perhaps identify as to what the IUA Cyber Committee is and what we're here to do. So we're here to bring together the London company cyber market to discuss issues that are relevant to the market. And perhaps share some best practice between ourselves. And we meet about once every 2 months. And then occasionally we produce some work to discuss our thinking on certain issues. That could be a model clause, or it could be a report or a question set for underwriters to consider. And we felt that, frankly, the market has had a lot of model clauses recently. And so on this issue, we decided to go down the report and question set route. One of the big conversations that we always have at every committee meeting is around systemic risk. So it makes a threat to the market. And obviously war has really dominated that conversation over the last few years. So we wanted to deep dive into another area of systemic risk as we see it. And we chose supply chain risk really for a few reasons. First and foremost, the way that wordings have developed over the course of the last 6 months as market conditions have changed means that wording changes have come into place and full supply chain cover has started to come back into the market a lot more. We see sublimits and other restrictions on dependent business income loss, especially to really start to go out of the market, much more challenging to attain. Additional premiums when we're able to charge for it are lower if they're even possible at all. And so I think the committee felt that if we're going to be taking on all this additional risk for not a huge amount of money for it, then we really need to understand it a lot better. I think on top of this, obviously, we've seen frequency really increase when it comes to supply chain attacks. And I think that's one of the best things about the report, which I'd urge everyone to download and read, is some fantastic examples that we've got in there as to how exactly supply chain attacks work, what the impact is, and what the insurability aspect of that is as well. So we're all seeing these attacks increase frequency, so we felt that we couldn't really ignore it. And of course, quite rightly, we're therefore getting a lot more questions internally within our own organizations about this exposure, so we need to be equipped to tackle that. And then from an external conversation point of view, our customers are actually really wanting to talk about this as well. They're starting to become interested in this space, and so we need to be equipped to have that conversation. But it's not actually interesting enough an area that they're entirely comfortable talking about. And so this is an opportunity for us to add genuine value to those conversations, which when you're having a conversation between a cyber insurer and, for example, a CISO, adding value is sometimes a difficult thing to do. And this is an area where we think we can really do that. So really pleased with this report. I'd like to thank all the cyber committee for their contributions to it. And of course, for CyberCube for making this happen.
Thank you, Thomas. Have you got any comments to add, Jon?
Sure. Yeah, thanks, Ellen. A few things I guess I would add from our vantage point. At CyberCube, we work with a number of the carriers and underwriters across the industry. But I would say a particular area of attention for us is, of course, in the catastrophe modeling space and the discussions around cyber accumulation. Obviously, that's something we're always talking about with reinsurers, with reinsurance brokers, increasingly with the insurance-like securities community. But there's a feedback loop, I think, and that's one of the important things that we try to facilitate in the market. If you understand and you have a view of accumulation and potential catastrophe loss, that should, roll back into the underwriting process in terms of some kind of catastrophe allocation or load in pricing and in the considerations around pricing. And I think one of the things that we certainly observe is that, while after the policies are written, there's plenty of concern about how things could accumulate. It seems like an important thing, and partly what we want to try to accomplish through this engagement is to bring that discussion kind of back to the point where decisions are first being made around taking on the risk. So I think that's an important point. And maybe to echo something you said, Thomas, certainly when we look at the threat landscape, so to speak, you're right. We have seen increased attention and attractiveness on the part of not everybody, but certain kinds of threat actors in terms of seeing supply chain targets as desirable, because kind of from a bang for the buck perspective, you can penetrate one entity and then either extort that entity for more because they're a more significant, they have more to lose essentially, and or use that then as a jumping off point to then sort of hit all the victims of organizations that they work with. And so that's certainly something we've continued to see in a variety of ways as we look across the threat landscape. So it was a good time to do this. Yeah.
Thank you. So the report highlights the need to pay attention to single points of failure in particular in the digital supply chain. Why do these occur and where should we look for them? And John, if I can turn to you first.
Sure.
Please.
So, I think we all recognize this, right? That the world is becoming increasingly reliant on technology. It's a webinar. We're using Microsoft Teams on a Microsoft laptop. If you're watching the recording of this, you're probably watching the recording streaming from Microsoft's cloud somewhere. Some of those technologies that we rely on become concentration risks, if you will, in that an enormous amount of reliance globally, certainly within any given country, is relying on the same technologies. The analogy that I'm using in the property space would be, imagine everybody in the country decided to move to Florida and live on the coast. That's kind of what we've been unwittingly doing digitally, and it's not with any bad intentions, but there's kind of a trade-off of risk, right? In many cases, I think the small businesses in particular have embraced software as a service, Microsoft 365, Google Cloud, Zoom, different technologies. And we're doing all that because it makes it easier to do business on a day-to-day basis. But the corollary that happens along with that is there's a huge amount of reliance that starts to get created on that service provider or that entity that we're not all relying on a consistent way. So some of those technologies that get to a point of materiality globally are what we call single points of failure at CyberCube. So where do you look for them? I just gave a few examples. They're actually not hard to find because it's the things that kind of become ubiquitous that we're all relying on. Certainly some can be more niche, within particular industries. There might be, document management systems that law firms use, or different kinds of, medical equipment that hospitals use, for example. There are some that are more industry specific, but certainly the ones that we tend to worry about the most are the ones that end up having the broadest footprint, that are kind of used regardless of organization size or segment.
Thank you. Thomas, any further?
Yeah, so I think from an underwriting point of view, what I said, we're looking at this through the lens of systemic risk, in particular capital threatening events. That's what we're really concerned about here. And we felt that sort of individual sort of isolated supply chain attacks, which impact one particular entity, are really sort of quite sort of affordable, so to speak. The frequency and severity is very much within our expected parameters. And even some so-called events where we have sort of multiple sort of insurers being impacted, not all of them are by definition systemic events. And so as we were sort of going through sort of thinking about scenarios that could be sort of capital threatening, I think it became quite clear that they all boiled down in their nature to that sort of single point of failure and sort of root cause. And so that's, I think, why exactly we need to be sort of focusing on this, frankly, just because it allows us to focus our efforts on where we're going to have the most amount of impact from a portfolio management point of view.
That's a good point. And that also, I mean, just something aside from this, something that I think the regulator has focused on the financial services industry, because they proposed a regime specifically aimed, I think, initially at the four big cloud providers. And I believe they've actually published their outcome of their consultation today. So I think some of these single points of failures, specifically in relation to financial services provision, will actually be coming under a regulatory umbrella for that very reason. That's very interesting. But yeah. In the report that we did, we focused on various case studies, and one of the case studies concerned the SolarWinds incident. In what way can motivations of cyber threat actors influence the outcome of a particular attack and its resulting impact on insurers and, I guess, clients themselves?
Sure. So SolarWinds was a very good example of an event that actually ended up not being of much consequence at all to the insurance industry, but it absolutely scared the information security community in a very deep way. And had SolarWinds played out a little bit differently, we would be sitting here talking about the history of cyber, probably not talking about NotPetya as the big event we've seen before, but talking about SolarWinds as we've seen before. So cyber attack can play out in many different ways. I think the thing to understand about SolarWinds, if you're not, close to the space, is because it's not a name brand technology that a lot of people use, because it's a network management technology that's used by the back end, tech stack sides of many organizations, particularly the governments and defense contractors would be important examples of that. And so, as a network management technology, not only is it used by many organizations, but it grants very, very deep access, privileged access into those organizations. And so it's very important in terms of how SolarWinds actually played out, that the Russian actor group that was behind the attack was motivated, they were just conducting espionage. And that's something that, all governments, I think, sort of accept in some way as something that, that governments do, and, ours all do it too. But they had very, very deep access into a number of different government institutions, probably not, because they needed that access everywhere, but there were particular things that they were probably looking for. Now, all they were doing essentially was, exfiltrating a certain amount of information, reading information. And so you can imagine the costs in terms of a discovery, across, whichever different government branches or, defense contractors that, insurers might be paying out on, it's pretty limited, and, probably with, either within retentions or, or the primary layer. But that same kind of access could have been used in a very different way. Had it looked something more like NotPetya or some of the ransomware or wiper malware attacks that we've seen in actually more recently, the Israeli-Palestinian conflict, or the Russia-Ukraine conflict, for example, that kind of access could have been extremely destructive, where instead of seeing, thousands of organizations kind of just clean up a certain amount of espionage, you might have seen thousands of organizations, seeing, ransomware or wiper malware on the networks at the same time. So one of the things that we contemplate in how we approach the analytics on these things is not only to look at what happened, but what we might call the counterfactuals, in terms of how things could have played out differently, but for one or two variables. And I think this is an important example, because we've certainly seen all the components of what could have been an extremely disastrous scenario. We just didn't see them play out in this case in that exact way.
It's very interesting and worrying, potentially. I'm going to ask this one to Thomas, if you don't mind. How can losses be established if the attack is made upon an insured third-party supplier? So obviously it's not the insured themselves, but one of their suppliers. So really interested to hear on that.
Yeah, sure. So I think undoubtedly handling a claim stemming out of the supply chain attack is always going to be more challenging from a claims handling point of view, and certainly from a quantification point of view. From an immediate incident response point of view, fundamentally you're not in control of the restoration effort that's taking place. Your access to information is very limited, and therefore your ability to mitigate the sort of the circumstances is severely impacted. When it comes to establishing losses, again, sort of, some interesting sort of factors here, in that when you have a traditional BI element, you tend to then get almost a complete shutdown, certainly of a particular business sort of unit. It may not be that the malware itself is shutting everything down, but you have sort of voluntary shutdown just to stop the sort of spread. And so that unit's shut down, and therefore the BI calculation is quite easy. That's perhaps sometimes less easy when it comes to supply chain, because it may only be a certain component of your system that you're outsourcing. And so trying to link the loss of business income to that particular sort of component is really sort of challenging. And ultimately, if you don't have the business control, then putting that sort of loss documentation together is going to be a challenge. And that sort of obviously increases the risk, also dissatisfaction with cyber insurance, under sort of recovery, etc. So I think that's the sort of the challenges. But I do think that there's some really good reasons to be optimistic about this. First and foremost, the wording over the course of the last few decades has really sort of morphed to become a lot more insured friendly in this. So it uses some broad terms like unauthorized access, unplanned outage, and that really takes away some of the causation requirements when it comes to proving the loss. You didn't really have to prove why it happened, you just have to prove that it did happen. I think our sort of third-party experts that we all employ following this are just so much more used to dealing with this now. So your forensic accountants, your loss adjusters, not only they got more experience on the cyber side, but actually they grew up on the property side. That's where they honed their skills and cut their teeth. And on the property side, they've been used to dealing with these supply chains, outages for absolutely decades. That is their bread and butter. So there's some really good skills there. And I think, so frankly, just insurers in general, and the claims handlers there are just quite reasonable in this space. There's a reasonable amount of leeway if you can demonstrate that your data has been lost or your company suffered disruption because of an outage. We're getting much more used to handling claims when these circumstances are stemming out of supply chain attacks, as if they were simply on the insurer's on-prem system. So there's a good experience there. I think there's some really interesting stuff happening, parametrics, which where you sort of take away the quantifying of the loss and taking away the causation of the loss. It's completely removed from the equation. So if X happens, you will get paid Y. I think that's a really interesting route to go down. I think the final challenge I'd highlight is around subrogation. That's, I think, the bit we haven't really gotten ourselves around yet. So real challenge on terms and conditions within the contracts. They tend to be very much on the supplier friendly side, especially in the digital supply chain space, where they don't want to take that liability at all. And as you go the larger and therefore more systemic providers, they're even more protective of their liabilities. And even if your contract does allow you to go and pursue damages, it's very, very challenging to go and prove. We've all seen those really skeleton statements from some companies, and sometimes that's all you've got to go on when it comes to the actual information that you're receiving, and not going to get access to those systems to go and prove anything more. And so, at Zurich, for example, we've been in plenty of situations where our insured has fundamentally done nothing wrong. It's entirely the fault of a supplier, but we've all just collectively judged it to be simply not worth attempting to go about seeking those recoveries, because we just didn't feel it's worth the cost of pursuing it, given the likely outcome that we're going to get.
A couple of things I might add to that. I think for us, we take a very broad conception of what supply chain risk could look like, or the single points of failure that we're talking about. And what I might say is there's two different basic flavors that we conceptualize, and you kind of touched on both of them. So just to kind of name it, I'd say the easier thing, like the more common thing that we think about is where the fault really lays with a supplier that you rely on. And so those claims are going to take the contingent BI, dependent BI type flavor. And it is interesting to note, we've certainly seen some examples of that, but we haven't seen, the big example where we kind of know how those things are going to play out at scale. But it's been an interesting issue with how cyber policies have played out, where I think it is harder to demonstrate harm to a certain extent for that forensic accounting to hold up when your own network has not necessarily been affected. So I think, we model those things, and we can map the dependencies, and we'll talk about that a little bit later on. But actually looking at, how the actual loss costs would play out and the extent to which it is an accumulation issue is, still a bit of an open question in that regard. The other flavor of supply chain risk that we contemplate is where something actually could propagate across networks and hit devices that are on sites, within organizations. That'd be more like kind of the solar wind type example where a number of different companies might, see something deployed in their own systems by virtue of using a software, but the software sits on your computer. So you're not just accessing it through a browser that sits elsewhere, for example. And so we think about that a lot in terms of how we put catastrophe events together in our catalog. Where does the loss happen? And so in those kinds of cases, you are looking at, a business interruption type occurrence, if it occurs, as well as maybe data recovery, investigation response, those kinds of things. That's a little, in some ways, those are the ones that scare me more. At least from a cost perspective, though, I think the investigation response certainly would look a lot like the kinds of ransomware claims, for example, that the industry's been paying out for years now. So I think we can wrap our heads more easily around what the things would be, just sort of understand that it's going to happen more at scale. Yeah, lots of different things to conceptualize and worry about if you need things to worry about.
Yeah. Okay. Turning to cyber insurance itself, and how things are managed with regards to general limits or limits on exposure, to named critical suppliers. Do you think they're effective? Is that a risk mitigation tool that is seen regularly? Thomas.
Yeah, so if I take sort of the named element, so first, what's the point of naming, and then talk about something limiting and sub-limiting. So from a naming point of view, unfortunately, the reality of it is that it's only really possible, certainly in the London market, to name non-IT supply chain. Whereas in reality, so much of the true systemic risk is on the IT supply chain basis, which is generally provided on an unnamed basis. I think this is to some extent a bit of a shame because property, for example, provides really sort of differing levels of cover depending on whether it's named or unnamed. So there's a really good example there where our customers have gotten sort of comfortable and sort of familiar with that sort of process. And I think sort of naming not only gives you an insight into the customer's thinking around this sort of space, because you go on the journey with them as to how they're going to name that, but it just sort of starts the underwriting conversation around that as well, and perhaps it starts to make us sort of think about that a bit more. But I do think from a systemic point of view, again, it could have a bit of a limited impact, because even if you're going to name your IT suppliers, in reality, the true tail risk from a systemic point of view is quite sort of isolated to a few sort of IT providers in the world, and they're always going to get named. So where's the real sort of benefit of that there? And on the non-IT supply chain side, we seem to have got ourselves into a position in the market where, okay, yes, we're insisting on naming, but then we're saying, but you can name your top 10 or top 50 suppliers, and again, where's the real benefit there, especially as our insurers get so much better at quantifying that non-IT supply chain sort of impact. So I guess it really depends on your objective. If your objective is to try to understand and to track and to model your exposures, potentially with the views maybe even reinsuring that, then that's actually a really good sort of start to go and do that, to really sort of record this. They're going to need a lot more info to be sort of effective. If your sort of, I guess, motivation is to genuinely reduce exposure, I think it's probably some more challenging, but it does allow you to sort of to focus and contextualize your underwriting a little bit more. From a limits point of view, I think that's where we would have so much more impact if the market were able to get into a position where ultimately nothing could be bigger than stripping limits down. And it'd be great for the market to get itself into a position where we're starting to trade off quantity of information, or also quality of controls that we're seeing, or rather the insurers able to demonstrate for those who get higher limits that are available. I think that would be an ideal reality. But the reality right now is that it's very difficult to attain, especially outside of the States. And yeah, like all systemic risk, not all vendors are the sort of are the same, not all events the same. And so I can see sort of the rationale from brokers, from customers to say, well, why are you just applying this blanket supplement across all of this? In reality, surely you should be restricting yourself if your objective is to protect yourself from systemic risk. You should be restricting yourself to limiting to that systemic risk. And that's why I think there's some really interesting and sort of crucial work being done in that sort of event declarations of space and classification space. And I think supply chain seems to suit itself really well to that event classification because it's so well and easily defined and so sort of temporal. And so, yeah, I think that's a really exciting space. I think once we get that done, then perhaps the sublimiting, the naming will sort of flow from that as we start to develop our market reaction to it.
Yeah, I would say it's what you said is pretty consistent with my impression of the market as well. I think it could be helpful if those limits were more granted, especially on the contingent BI side, where you can see the relationships and you're going to be affected if there is an issue. I think in practice, kind of parallel to the supply chain conversation, there's the broader market conversation about widespread event sublimits potentially. There's different ways that's kind of being potentially played out or tested in the market. And I think it's maybe a bit broader recognition that regardless of the source of the issue, the industry has a limit, and maybe there's a different way to kind of rewrite the contract with the policyholder such that maybe we're offering a little less coverage, but we can do that for like 50% more insureds in total or something. And so it's been interesting to see those different approaches play out. It doesn't seem like there's a clear winner yet at all in terms of how that is, but it's something we've certainly tried to enable through our products in terms of allowing customers, underwriters to sensitivity test the different impacts of one wording versus another in terms of, could you sublimit this and what would that do to your tail risk versus a different approach? And, can those things be effective and to what degree are they effective in potentially reducing exposure?
Okay, thank you. In respect of one of the other case studies that we included in the report, which was Dropbox, I'd be interested in your opinion on whether you think the human aspect or element is still the biggest vulnerability.
Yeah, I guess my one word answer would be yes, but I think maybe the extrapolation of that is maybe helpful. What happened with Dropbox? An employee's account got compromised, and then the actor was able to get privileged access into the network, such that they could have had quite a bit of data as well as contact information from a number of different organizations that rely on Dropbox as a file storage company. That wasn't a particularly significant event, again, in terms of how it played out. What it might have allowed for is, you sort of, you fish Dropbox, you get into Dropbox, and then you sort of have this means to fish a whole bunch of other companies that rely on Dropbox. You can imagine getting an email saying like, you need to reset your password, to get in again. And, some people are going to go for that, or that kind of a thing. We use a framework that's commonly used in cyber defense called the kill chain framework, which is sort of how the threat actors go step by step from kind of initial exploration through to ultimately carry out their objectives. And I think in that kind of case, the human element is the issue, but that's just kind of the first point of vulnerability. And you can get a certain amount of access from that, but there are many other ways to subsequently stop an event from becoming more material. And these go back to things they're probably very much part of the underwriting process. Do you have backups? Are the backups on-site or off-site? How frequently do you back up? How segmented is your network? Do you use multi-factor authentication? All those kinds of things. So that's always going to be a vulnerability, but unless the robots are doing everything, that's always going to be there. It's more about how do we build systems to anticipate that will happen in certain cases, but then what are the steps that we can take? In government now, beyond government, zero trust as a model is becoming much more common in terms of, instead of assuming you have a really broad moat around your organization, just hoping that nobody can scale the wall, so to speak. just assuming that that's going to happen, but then just thinking about layers upon layers of barrier, kind of once somebody's inside the organization to mitigate it other ways.
I think from an underwriting point of view, yeah, so generally speaking, within severe cyber insurance, obviously, yes, human error is a huge vulnerability. So for us, it's very challenging for an insurer to control or improve. It's about slow cultural change. It's not about buying in a whole load of new tech or changing processes. But I do agree that from a systemic point of view, it's perhaps less of a sort of focus. Most of the scenarios we think about are about technology failure. Yes, it might be, as you said, yes, of humans of failure that is the in, but it's technology failure that allows that to really get to a systemic point. I would say it's an incredibly challenging underwrite for us in that it's challenging to underwrite the human element of our insured's own severe employees and their severe systems. We get some quite little information in that regard. But to go and underwrite to the controls around the employees of your insured supply chain, that is like just nigh on impossible, right?
Yeah.
And so as a result, I think we sort of try to really sort of avoid that from my point of view, and we sort of really sort of just jump to the, well, how are you as an insurer going to respond to that supply chain failure, rather than the internal controls within your supply chain that might prevent that failure.
Yeah, makes sense. Okay. Turning to something else that we looked at in the report, I'm going to ask Thomas, what does best practice look like for a client wanting to demonstrate that they have effective management on their digital supply chain?
Yeah, I think this really goes a lot to some of these sort of suggested underwriting questions that we put forward in the report, which I think is one of the most value add there. I really appreciate everyone's sort of views on it. I think ultimately managing IT supply chain is a challenge, especially on the critical ones which present that systemic risk. There tends to be a bit of an imbalance of power between the supplier and the customer. That could be through size or lack of choice, or just sheer sort of ongoing dependency. So in designing our sort of question sets, I think so perhaps the notable stuff is what we chose not to go and ask. So we avoided questions, for example, around contractual controls, because we just know through really painful experience how difficult it is to go and set subrogate, how one side of those contracts tend to be anyway. We didn't really talk as huge amount to selection criteria, because we felt that it's perhaps unrealistic to prioritize digital security when it comes to onboarding. Suppliers really just want the best tech that's available, to just about seeing a function mostly. We didn't actually even talk really much about auditing. That's one of the common question sets that you get. We didn't talk much about that because we know how difficult it is to gain access that would allow this auditing to be really effective. And we know that IT supply chains are fantastic at ticking boxes, but that doesn't necessarily represent a fantastic information security. So instead, what we decided to focus on was, as I mentioned, the impact on the insured. So getting them to think about what their world would look like if part of their digital supply chain broke down. How likely would malware be to spread to their own systems? How they would react to different scenarios, whether that's a breach of confidential information or a sustained outage for a long time. And then acknowledging that there's only so much that we can glean from a case by case basis. There's perhaps more to be done on a portfolio basis. And so that's, I suppose, why we then start to focus on the single points of failure, because of the limitations that we have on the underwriting side. Let's get us think about where this could truly go wrong.
Yeah, maybe just to add to that, I think maybe to take the line underwriter perspective, but I'm more like the CEO perspective. Yeah, I think the line underwriter question is primarily just that, if the organization's affected, what's your plan? That's probably the most important thing. Again, orient toward resilience and getting back up and running. You're never going to be able to prevent everything. I think from a CEO point of view, that's where the accumulation really comes in more. What's this going to potentially look like? We have tools that can help organizations kind of look at their total amount of exposure, and then if you want, benchmark that. Are you over or underexposed relative to the industry overall? Is this going to be, you can't prevent everything, but is this going to be an outsized exposure to you or not? Are you underexposed? Maybe you can grow a little more in certain segments. So those kinds of things are worthwhile considerations. One thing I mentioned is we actually just released this in a new feature in our risk scoring and risk selection underwriting product last week, is the notion of marginal risk. So, for reinsurance, for capital, for regulatory reporting, you've got some number you're reporting. In London, it's often the 200-year, EP point, PML point, whatever. So, a question that often comes like, hey, when I'm looking at each new account that comes in, what is that doing to my tail number? And am I, this is all insurance is predicated on diversification, but we know that there's these systemic, single points of failure that lead to concentration. So to what extent am I growing my tail as I grow some of these new points? And if it's a company that's not particularly assigned to those, like I can kind of like not add any new capital need and still grow my book that way. So like allowing for those kinds of considerations, again, to kind of that feedback loop between what is the tail risk number I need to manage around, and how does that kind of translate back to point of underwriting on the things that I need to concentrate on.
Okay, we've mentioned the case studies included in the report. I wanted to ask about the different models that are available, how accumulation risk can be modelled, and what particularly is the regulatory view of the modelling available. Certainly our members, something our members are definitely interested in.
Sure. So that's a big, broad topic. We can spend a lot of time. I guess what I'd say, the way I'd approach that. So analytical models for quantifying risk have been available for a number of years now. I started to get into this space back in 2015, shall we say. And we've seen the vendors, including CyberCube, evolve quite a bit over that point in time. We're on version 5 at this point of our catastrophe model. And we've seen the market kind of mature along with that, partly to address some of the market needs in terms of things that are maybe more difficult to assess at point of underwriting, but there's a way to, gather data sources in a way that we can kind of collate and identify that exposure, for the insurer in a way that might be more difficult to collate yourselves, and then, run different analytical models on that. So, so that's been an exciting space to be part of, and we've seen a lot of maturation there. Including, we're very excited. Just recently, the first fully public cat bond was just issued using our model in the last week. It's been a long, it's been a long week. In terms of how regulators approached it, obviously they've been watching what we're doing closely. They've also needed to develop their own approaches, kind of independent of that. I think if you look at, Lloyd's is a good example, not the only example. I think the stress testing approach has been kind of the first one that many have embraced, where it's not necessarily a fully developed stochastic event set approach, but it's sort of, here's some plausible approaches and things that we generally have a belief that the industry needs to manage to, for the most part, that looks at kind of widespread data breach, widespread cloud outage, widespread malware, ransomware kinds of things. That's the industry's kind of converged around those. Others have kind of taken the approach of just asking more questions. Kind of maybe not prescribing the thing so much, but show me you have a thought process. And so we see evolution. I think some of the regulators are moving more towards stochastic modeling, more toward specific points on the curve that they might expect you to report on. But I think one of the important things to keep in mind, obviously we're not the only vendor in this space. There's other vendors that have their own approaches as well. But in many, the brokers also play an important role in terms of working with clients to understand the risk. And so I think it's important in terms of like when a regulator is collecting data, not only to sort of go through the exercise and get the information, but kind of ask the next 5 questions that you get after you sort of get the information. Because it's actually something we care about a lot. We want our clients to have flexibility in how they use the product. It's, I think the property cat market did this for a while, but I think in cyber, it's probably always going to be a world where, we have our default view, but each organization needs to kind of use our view to inform their view, and how they want to communicate internally to their stakeholders about their view of risk. And we very much want to facilitate that. So we have a number of different bells and whistles that you can, dial up or down, mixing metaphors, in terms of how the model runs. But what that means is that people can get different kinds of outputs out of our model or the other models. And so just kind of saying, hey, which model did you run or what's the answer isn't quite enough. You want to ask some further questions about, were default settings run? Did you make modifications? If so, why? And why did you feel they were appropriate? How much did you investigate the answer and look at it? And I think there's additional disclosure that I think would help regulators and kind of help the whole market. I've seen some reports where like they'll kind of say, hey, the models are all over the place. And it's like, well, it's not the whole picture, again, because I think it's more so to say different stakeholders are getting answers that are quite different, and there might be valid reasons for doing so. Again, like we think you should model appropriately the exclusions that each carrier is looking at, and that's going to vary from carrier to carrier. But it's important to understand that, and some companies are just naturally more conservative in how they approach it. Others are naturally more hopeful, maybe shall we say, that they're not going to be affected by it. So I think that's kind of the thing that I'm looking to see the regulators get into, is maybe kind of suss out how much of that customization in the approach is really appropriate, where the carrier can say, we've thought about this and we think this is really what best represents our organization, versus maybe kind of just looking at different levels of caution in terms of how they think about tails.
Yeah, interesting. Thank you. Thomas, what do you think the level of awareness amongst clients is of supply chain exposure? And I'd be really interested in your thoughts on how this could potentially be improved.
Yeah, so it's hugely variable at the moment. I think, generally speaking, it's improving and increasing, and more customers are willing and able to have that conversation, but still varies to a huge amount. I think what I've noticed is that, surprisingly enough, they seem to be more prepared to have a conversation on the non-IT supply side than the IT supply side, and I think that's where, frankly, they've got the expertise, of themselves and what they've been managing for some time. They've got the experience, they've got the tools in which to do that. And I think the tools are starting to improve on the IT side, but they're not quite there yet. And it's where perhaps they felt the heat over the last few years during the supply chain crisis, so to speak. So they've been in crisis mode managing that. So I guess from a first step improvement point of view, take what you're doing on the non-IT supply side and all that sort of good work you developed over the last couple of years and start applying that, or thinking about how to apply that to the IT supply chain, and then sort of share that with insurers would be great. I think from an awareness point of view, one common sort of perspective that I get all the time, a shocking amount of time, is, well, if one of our cloud vendors providers or one of our key IT providers goes down, then we're all going to have bigger things to worry about, right? And like I said, it's almost like it's so cataclysmic that they'd rather just bury their head in the sand and not think about it. And I've always found that's a bit sort of weird. So firstly, there are plenty of material but not cataclysmic events to be worried about, in between the two extremes. So you should let's prepare for those as well. So secondly, yes, okay, maybe some of your peers will also be impacted, but that doesn't take anything away from how you're going to be impacted as well. I think from sort of an improvement of the awareness point of view, I think the cyber insurance market can absolutely play a role in raising awareness, and ultimately certainly risk quality. And I think we should all be really proud of the way in which the cyber insurance market increased resilience to ransomware over the course of the last couple of years, and to some extent sort of drove that conversation, certainly with risk managers, if not necessarily with CISOs. And I think that there's absolutely potential for us to play the same role when it comes to supply chain. I think the risk managers and to some extent CISOs just need to be poked out of their comfort zone a little bit, that within their own on-premise systems, within sort of their non-IT supply chain, they're quite sort of comfortable, but forcing that sort of conversation by asking those awkward questions about the what if scenarios, I think that's a really useful sort of thing that the cyber insurance market can do. I think that I think that's a real value add to having that. And of course, if anyone wants to download the paper and distribute it to their customers or brokers, they'd be more than welcome to do so.
Yeah, freely available on our website. There will be links at the end. Don't worry. John, have you got anything to add to that?
I would agree with everything that Thomas said. I think that the thing that's just struck me maybe is around the point of materiality. I mean, it's worth bearing in mind cyber still it's a comparatively small line in the P&C space. Now the limits are starting to get more significant, certainly, but yeah, kind of to echo your point, it struck me some time ago that the event that's going to wreck the organization is much further out in the tail than the event that's where the head of cyber is gonna get a lot of unpleasant questions, and I think cyber's an interesting line, being, as we would say, a catastrophe exposed line, but still generally managed as a PI or a PL line. Having that kind of mentality where you're more worried about volatility in this year's loss ratio. I think one of the things that we kind of want to impart to the market is the recognition that, like similar to property cat, that occasional significant tail losses might just be a normal thing, just given the nature of the connectedness and the nature of the systemic things, and that's not necessarily a reflection of poor judgment on the part of the company. Obviously, you want to mitigate that to the extent possible and not be the outlier that has an outsized event relative to peers, but that it isn't a failure on the part of the insurance community if there's a cyber catastrophe event that happens, provided it's been appropriately accounted for, limits managed to. I think if those kinds of things happens and they are not of such a cataclysmic level, it's actually probably a good thing for the market in terms of giving us the ability to understand what we're actually seeing and refine our assumptions and our understanding of the peril. We can all kind of go on in a more informed way, similar to what you mentioned, how we have done with ransomware the last couple of years.
And talking about refining assumptions, the availability of underwriting data is a key question for cyber insurance generally. Do you think this is more or less of a challenge for the digital supply chain? Thomas, I'll come to you first.
Yeah, so it's undoubtedly a bigger challenge for us. And I think that's part of the reason why we want to engage in this debate and write this paper. If I sort of think about my 10 years in the market, we have come so far when it comes to gathering data and information about our insurers' own systems, their approach, their own internal sort of risk. But I think our understanding of this supply chain space really hasn't moved on from a data collection point of view on an individual case-by-case basis in that time at all. It's still really woody. It's still really sort of unquantified, so to speak. And I think there's so much more sort of to go, and hopefully this just begins the debate on that. I think if we look at the approach that property are taking, we're obviously well behind there. That's a very data-driven approach to supply chain risk. I think the challenges are pretty obvious, right? It's about internal expertise. I think the tools are still developing, perhaps like a focus, and I think we can sort of really bring that focus to the table. And I think that there's some challenges that we can overcome as well. So, for example, we're all asking some quite different questions at the moment that may or may not have a huge amount of needle-moving impact. And if we can start thinking about what that looks like as a market, I think that'd be great. And of course, in the absence of some true sort of case-by-case underwriting data, we will of course look to technology to go and fill that gap. And I think that's where CyberCube and their peers have come in, because we will never get to a perfect sort of data view on this. But you combine that sort of tech-enabled view with hopefully better information on the case-by-case underwriting side, and I think together we can really start to tackle this systemic risk. And therefore, protect all of our employers, protect the market, and the more positive side, hopefully unlock the much needed capacity that this market is.
Yeah, I remember in 2016, early that year, when Lloyd's made an announcement, they had built a data schema for cyber. It was like, we figured it out. Here's all the stuff you need to know. And some of us at the time we looked at it like, organizations don't have this stuff, and they probably have a little bit more now. But that's very much what companies like ours have recognize the need to step in and help with. And so in many respects, I think we kind of play back the issue from the other side. We are able to gather a lot of data and sort of present back to you, here's what we see. And we're not 100% confident in everything, and we're transparent about that. We try to be use different data sources to either corroborate or kind of discount the extent to which organizations in fact rely on some of these things. But then you can play that back and you can run different tests and you can kind of evaluate. So yeah, I think the data collection issue in particular, this is the kind of thing where, because it's more concentrated and potentially systemic in nature, it's not enough just to say at point of underwriting, I got comfortable with this. It's, I need to accumulate that information in a consistent way that I can then aggregate. And that is a pretty significant data collection problem, I think, for many organizations. So yeah, that's certainly a place where we try to help that conversation along.
Certainly something that we've also raised with government, and the National Cybersecurity Centre about potentially sharing further data with the industry. Well, those are all the questions that I had from my side. So thank you, Thomas and John. We do have a question pre-submitted by the audience because we all asked, which I'll ask now. And we also have a question to answer submitted by our current audience. So thank you. So the pre-submitted question asks, can we model the potential effect of mandating cyber insurance within some procurement processes in the economy, e.g. within critical national infrastructure, government or SME supply chains? Are there any interventions that could be made? So quite a comprehensive question. I'll be glad of anyone's thoughts on any part of that.
Yeah, I'm happy to take perhaps the public policy aspect, and we'll defer to the expert on the modelling as a part of it. But I think from a public policy point of view, I think it's frankly unlikely that we're going to see such mandating anytime soon. I think there's really little appetite in government at the moment to add to the cost of doing business. So right now they're trying to do some sense of the opposite. And I think that sort of the public protection argument, which is the argument that's always been used for mandating insurance in the past, is not necessarily particularly sort of strong enough when it comes to cyber right now. But I don't think that necessarily means that we're not going to get a huge uptick or sort of a material uptick in sort of uptake in insurance because of supply chains at risk, and that therefore can be sort of semi-mandated from the top down. So I think we want positive reasons to buy rather than sort of a declaration we have to. And I think there's got to be through sort of contractual requirements whereby contracting free willing contractual parties sort of agree to say, okay, cyber insurance is an appropriate protection for all parties concerned within that contract. And if we can start to normalize that as a contractual requirement, especially in the space that she mentions, then I think it will sort of essentially become almost a compulsory class of business through the back door rather than needing government intervention.
Yeah, from a modeling point of view, I think there's maybe a few different ways to interpret that question, but I think the way I might take it would be, what would the market look like if that kind of thing were to occur? Certainly that would be to increase the take-up rate of cyber insurance. And given that most large corporates already buy or have a good reason not to, like they have a 10-year policy or a captive or something that they've dealt with it through, presumably that's going to increase the take-up amongst small commercial enterprises to a greater degree. And that's something we certainly look at. We imagine that would help with the diversification of the industry to a great degree. We tend to see more tail risk in the industry coming from larger insurers. So I think growing the pool of small businesses that participate in the cyber market probably would be beneficial overall. So that things we can look at, and whether it's mandated or not, I mean, there are parties that are looking at that. The United States Treasury is maybe an example we've been in dialogue with over the last year. Recently, there was some discussion in New York. It seems like conceptually people are on board with the idea of a cyber backstop analogous to what's done for terrorism. And one of the questions that's going along with that is, can the government help incent and motivate either greater take-up or, more controls and resilience to kind of manage down the risk of this exposure. So we look at loss at that more societal level, both on an economic basis and an insured basis. So the economics not necessarily going to change in that situation, but the insured losses might come up, but in a way that sort of makes the market more robust with a bigger base to spread things around.
The other danger about mandating some insurance coverage is that with mandating a putty, that comes with minimum terms and conditions and so forth. I think that could really sort of stifle what is a very innovative sort of market.
Fluid
market, exactly. Which needs to be fluid in order to respond to an incredibly rapidly changing risk landscape that, frankly, the government couldn't possibly hope to keep up with.
Good point.
Yeah. Thank you. Okay. Questions from our audience. So first one. So does the panel believe that the new EU obligations, which will be introduced under DORA, and for those that don't know what DORA is the Digital Operational Resilience Act, will make any significant difference to the oversight of the supply chain risk? I'm not sure that's quite a difficult one to know.
I don't think I know where to start on that. Other than if we looked at some previous regulation that has come in, it has absolutely suddenly focused the mind, especially if the more sort of punitive element of that comes with it, which gets some board level attention, then that tends to drive improvements from the top down. So I suppose in theory that's yes, but I'm afraid I'm not hot enough to the detail to answer more on that.
Well, thank you for the question. Next question we've got here live, is from a regulatory perspective, do we expect the UK or the EU regulatory environment will move to levy stricter penalties or have nuclear verdicts like might be seen in the US and potentially have been seen in the US? I mean, I certainly know, as I mentioned earlier, that in the financial services sector, this is something the regulators are concerned about, that concentration of risk element, and which is why they're bringing in a regime to designate what they consider critical third parties to the financial services sector and kind of put a regulatory umbrella over them, because I think there's an understanding that even if you're a huge reinsurer, actually negotiating special terms with Microsoft in a contract, you just don't have the bargaining power. So kind of making some regulatory requirements as an umbrella over some elements of this. But I'll be interested in hearing anyone's thoughts.
So I think if we perhaps look at sort of the current environment and the willingness of information commission officers and regulators in the UK and the EU to go and impose such fines, I think perhaps we'll start from there. So obviously when so especially GDPR fine penalties first came in, a lot of people got very excited about the headline amounts of 2 to 4% of global revenues. But I think what we've seen is that in reality, a distinct lack of willing for regulators to go and apply anything close to that level for the vast majority of businesses. And I think it would just be quite a disproportionate to do so. The very, very few occasions where it has towards the top end of that range, it has been for the most egregious acts. And as you say, it tends to be for those larger entities who have that disproportionate power over other entities or over the general public as well. So I can absolutely see that continue to happen. And to some extent, if those larger, frankly speaking, tech entities don't then take the message, as it were, and as you start to get that second, third, fourth fine, I can absolutely see that escalating up. But from a general approach to your average run-of-the-mill insured, I don't really see that changing anytime soon because of the disproportionate nature.
Yeah, GDPR was actually the example I was going to use as well. So I was a little curious where the phrasing around nuclear verdicts, where that came from, because in that regard, I actually think the European regulation has been ahead of a lot of the US in terms of willing to make examples of some of the large tech providers who also are, part of the digital supply chain. And whether it's because of that or something else they don't like that Google or Meta are doing is maybe beside the point. But that's a good example. I think maybe what they might be referring to, the biometric litigation in the US has become quite an interesting thing to watch. And I think what's interesting with the US is just I think we are at the point where there just is so much different regulation, like probably in the absence of a federal policy that just says, this is how it is and you're all part of it. There have been different states and different branches of the federal government that have put different things in place. BIPA is probably the one that's been the most litigated to date. So, we'll see where that goes. I do think, I'm not going to make a forecast here, but certainly culturally, it seems like the UK and Europe are places where data is taken more seriously than it is in a lot of the US, and privacy is kind of treated more earnestly as right when it comes to data. So it wouldn't surprise me if something like that came along, but we also know that takes time. So it's probably not going to come out of nowhere.
Yeah, that's a good point on the damage point of view, because I suppose that's the other side of it, I suppose, the pure regulatory. I think actually in the UK, we've seen it perhaps go the other way, where courts have been starting to really attempt to moderate the damages in line with the true, I suppose, injury, severe damage that the insured individual, the individual has felt. And I think that over the course of time, that has been perhaps moderated slightly down compared to the larger headline stuff that we saw early on.
Yeah, lovely, thank you. Well, that's all we've got time for. I want to thank everyone that joined us. I'd like to thank Thomas and John very much for their contribution to this panel. A very important note to say that the report is available on the IUA's website. There will be a slide at the end, which will have a link. And also, I think there will be information sent out after the event that will include information of where to download the report. And if there are any further questions, please don't hesitate to send them into the IUA. And we'll put you in touch with CyberCube if you have any questions for CyberCube.